You've got a very interesting new product out as well. I've known you for many years, but this is a really interesting one.
Yeah.
You launched the Innovator Hedge Tesla strategy,
Yeah.
which seeks to track the upside performance of Tesla to a cap. Now, explain how this works.
Okay.
It's not easy for investors to get their head around it.
Yeah.
We do have a full screen, but just
Yeah.
explain how it works.
Very simply, really the idea is a lot of people want to purchase Tesla. They want to be involved with Tesla, but they're worried about the volatility of Tesla, also the valuation of Tesla. You know, if Tesla was valued like Ford, people would lose 90% of their value right away. So we're saying for those people that want to get in, they want a long-term investment, this is how it works. You buy TSLH, Hedge Tesla, you get basically 10% on the upside, and you have a 10% floor. Now, what a floor is, that's a max loss of 10%. So if Tesla goes down 20%, you lose 10%. If it goes down 50%, you lose 10%. And each quarter, that resets. So at the end of September, it will reset on the calendar quarter, each calendar quarter, and you get another, whatever the upside is. We don't know exactly what it would be. Right now, it's 9.23% when we just launched it. Each quarter will be in that range, and then you have a downside of max loss of 10%. For example, let me tell you how somebody could use it. I had a big appreciated position in Tesla, up 800 some odd percent over the last several years. I decided to take my position, roll it out into this. And now I only have I have a max loss of 10% in this. Now, I'm not going to get as much upside, but we don't believe that Tesla's going to have that kind of upside it has in the past. It's a huge, think of it, it's not a trillion anymore, but it was one of 5 or 6 companies at $1 trillion. They only sell 1.5% of all the cars in the world. Yeah. Does that really make sense? Yeah. And what we're saying is, we're not so sure it does. We think a lot of people are concerned about it. There's a great way for you to stay with them. 2
points here. First, this is essentially a collar trade, it seems to me.
Yeah, like similar.
There's an upside. Now, you're saying it was 9%, but the way I put it up there it was 10%. So if in a quarterly basis, if Tesla's up 12%, you're only going to get 10%
exactly
of the 12%.
Exactly. You're only going to get up to the cap, and then you give the rest up.
Right. And there's a downside protection here. So I think it's important to know you don't actually own Tesla shares. You own Tesla options and treasuries, right? And that's how you get this
That's
mix.
exactly right. That's how we give that position to people so that they can, they can get exposure to Tesla, but without all the risk of Tesla.
Yeah. So the other thing people have a hard time getting their head around is this reset.
Sure.
And leverage and inverse for years, we keep telling people these things reset every day, and people can't understand and get their head around what a reset means. This is a quarterly reset.
Yeah.
So timing kind of makes a difference here, doesn't it?
It does. It does. I would encourage people to go to our website and see where it's at, because since we launched it, Tesla has moved up some. So you may only have about 5% left on the upside from here. But if you get in around the end of September, when it resets,
it's important for you to know when you're getting in, right?
It is.
You can't just say, I'm going to buy Tesla. It's going to be in the middle of, the quarter.
Well, you can, but it's important for you to know what your outcome. You can find out your outcome any day. If you go to innovatorsetfs.com, go to the website, look up Tesla. It'll tell you, well, you have this much upside left and you have this much downside. Right. And so you can see every day what your exposure is and what your opportunity is.
So this started, what was it, July 26th?
Yeah.
Right? And it resets at the end of September. Is that right?
It's a shorter period this first time because we're trying to get on the calendar quarter. So it was just 2 months, really, this first time.
Right. But my point, I'm sorry to keep repeating this, but I know people were going to get confused about this. It's really important to know when you're going in and buying it.
Yes.
Because if you're in the middle of the quarter and Tesla's already up 5%, you've capped really another 5% gain, essentially.
Well, so what has happened is Tesla is above the cap already, but the fund itself is only up about 4.5%. So you have another 5%. So let's say if Tesla doesn't move from where it is, the fund will, as the options expire, will go up to the cap.
Yeah. All right. I want to point out that Bruce has got some much broader products that are out there other than the Tesla one. I know we're dwelling on that. But last year you launched a broader buffer product, the Innovator Defined Wealth Shield. This is BALT, BALT is a symbol, and it tracks the return of the S&P 500 to a cap. Very similar. Here's a full screen explaining it, but Bruce, again, just walk people through what you're getting.
Yeah, so on BALT, what it is, it's meant to allow people to get into the S&P 500 with very little downside, but exposure to the upside. So the way to think about it is, you have it's quarterly again, so each quarter it resets. And Bob, to your point about the reset, remember, you don't have to do anything at the reset. The fund automatically resets and gives you a new cap and a new buffer in this instance. So BALT is based on the S&P 500. It has a 20% buffer to the downside quarterly. So if the S&P goes down 21% during a quarter, you would lose 1%. Now, you get 2.5% of the upside quarterly. So it is very rare. Like if you look at first quarter this year, it didn't even go down. It was down like 15%, or second quarter actually. So you didn't even get into the 20% this year, how volatile the market was. Now, why would you buy this?
It's a pretty long-term put, a pretty far out put there.
Well, it's just a quarterly.
Decline.
It's quarterly, but it's a 20% decline. It's a buffer.
Yeah.
And so why would you buy this? Why would you use this? Well, the reason there's been so much interest is people that don't want to buy bonds, they know rates are going up, they're pretty sure they're going to lose money. They would rather link their low-risk money to the equity market with a 20% buffer against losses. So you aren't going to lose in that first 20%, and take this 2.5% or whatever the cap is on a quarterly basis. Remember,
right. So,
it'd
but
be 10%
if you're up
over the year.
5% on the quarterly basis, if the S&P's up 5%, you're only going to get 2 points.
You only get 2.5.
Okay. So there's a little bit of a call here just above the market.
Exactly.
And a pretty big put way below.
Yeah. Well, we have a put spread at the bottom. We buy a put and sell a put. And then we have to actually sell a call at the top. That's what gets you your cap to build the position.
Right.
It's a
so
zero cost.
It's all options. You own all options.
It's all options.
Yeah.
And it's a zero cost position for people. So a lot of people are saying, hey, I'm going to take maybe half or a quarter of my fixed income position and link that to the fixed income market, go for the 2.5% on the upside, link to the S&P 500 rather than just stay in the fixed income market.
You know, I know these buffered ETFs have gotten some assets, but they are difficult to understand. And the regulators have voiced alarm over these kinds of complex ETFs. Folks, I've talked about this on the air. We've had Gary Gensler, the SEC chairman, on. He warned earlier, he calls them complex products. They could pose risks even to sophisticated investors and can potentially create system-wide risks by operating in unanticipated ways when markets experience volatility or stress conditions. This is Gary Gensler. What do you say? Gensler is targeting, initially made comments on single stock ETFs, but this falls under what he calls these complex products that are difficult to explain.
This new ruling that came out, this new ruling that they came out, they asked questions for feedback. But remember, there were all kinds of ETFs, not even options-based or not even daily, that were kind of encompassed in this thing. I mean, he called a lot of ETFs, complex. And really, the important thing to remember, when I started selling ETFs back in PowerShares way back in 2002, 2003, nobody knew even what an ETF was. ETFs were considered complex. And just because it's new does not mean it's complex. Sometimes it takes time to understand what it is in order to understand how it works, because I would just tell you that the buffers bring tremendous value, risk control value for thousands of investors now and advisors. And it's a great tool in the marketplace. And I think FINRA is starting to realize that, and the SEC is starting to realize that. And so just because it's new does not mean it's complex.